Well, good morning, everyone. Welcome to Trading a Smaller Account. Sorry, I'm just got sidetracked. I'm just bringing up my PowerPoint here. Oh, and it doesn't want to let me bring it up. What's the deal? Let me see if I do it this. There we go. Okay. Good morning, everyone. Welcome to Trading a Smaller Account. My name is Barbara Armstrong. I'm a coach and senior manager with Charles Schwab. And today we have a jam-packed class. So what is on the menu for today? Well, we have one trade that we have to manage because it's expiring today in the money. And with a short vertical, that's not always a good thing. So we've got something we have to manage. We're going to place 4 new example trades. So 2 different trading strategies, 4 different stocks. And then we had a trade that we placed a few weeks ago where we did 2 trades on one stock. That stock was Baker, and we did both a call and a buy right. And I said that when all was said and done, we would compare them. And so time allows, we'll compare those 2 trades as we wrap up the class. So yeah, somebody's saying, hold that flag high. Yes, I'm flying my own little, nerdy freak flag today, in addition to the Canadian flag. But I want to thank all of you who show up live here every Monday and Friday and Wednesdays too, because we've been treating the trading price pattern class as a companion to this class. So thank you. And thank you for all of you who are so participatory in the chat. So to Janelle and Jack and Mighty Mouse and Dan and Will and Sharon and Jose and Robert and Ask a Coach, and Will with his Canadian flag, although he lives in California, but, there we go. I think you're in California, right? Well, and Eric and Marcus and Lola and Josh and the rest of the gang, thank you all for being here and for being so participatory. We also have Connie Hill with us in the chat today. She's a friend and a fellow coach, brings a wealth of experience in addition to her fabulous red hair. If you're not following her on X, you're missing out. Connie Hill CS and Barb Armstrong CS. Be there, be square. Okay. So just before we get into the thick of things, know that we do trade a lot of options in this class. It's also an intermediate level class, and I move quickly. So here we go. Options carry a high level of risk, aren't suitable for all investors. We use the Paper Money software application on the Thinkorswim desktop platform, which looks like, smells like, feels like real money, but it's not. What are some of the differences? Well, short positions will never be assigned early in Paper Money, and that can happen in a live account. Have I seen it happen? Yes, I have. Okay, so we need to be aware of that. Okay, we're going to do a super quick market overview because 4 mornings a week, Kevin Horner, or today it was James Boyd, have a fantastic 45-minute class, which is all things market overview. And so you may want to go back and check those out if you haven't been watching them already. So that'll be super quick. We're going to play some new example trades, and then we have one trade that we have to manage, and then one trade that we want to review. Okay, so the trade we're reviewing, I've already let the cat out of the bag there. That was Baker. But, when we look at the S&P 500, just a few trading days ago, we hit a new, all-time high on this market. And then we had a 3-day pullback. Setting up what appears to be a bull flag. Yesterday, we had this hammer pattern. What we're looking for as confirmation is for today's close to be above the body of this candle from yesterday. And we've got another inverted today. It's an inverted hammer. But this is a live candle, so who knows where it'll be by the end of the day. But it looks like things are perhaps ready to move on up again. So hard to characterize this trend as anything other than bullish, right? And the same thing on the NASDAQ. It's up now almost 15% year to date. We had this hammer type pattern yesterday. Today, just down by a smidge, like, 0.14%, but the day is young yet. And then how about the Dow? Dow 30. I'll be posting a little video on kind of 5 interesting facts about the Dow. But, another fact that I didn't talk about in that short video that you'll see on X is the fact that it too hit an all-time high just 3 trading days ago. Bit of a bull flag that appears to be setting up. And, today we have an inverted hammer appearing, and this is the 10-day moving average. So something is pretty darn bullish when you think about it. If, the 10-day moving average has been serving as somewhat of a support level. And if you had a 20-day moving average, it might be catching the tails on this. But again, a pretty bullish trend overall. How about our small caps? Well, our small caps have actually been the most bullish. They've had the most bullish trend over the last 3 months. And again, this 3-day pullback, we're seeing an inverted hammer today. And, today so far up, 0.3%. And then if we look at the VIX, okay, we may need to kind of scoot out a bit. But, when we look at a 1 year on the VIX, it was up a little bit over the last week, but at 1642, kind of, in the middle of where it's been trading for a lot of the last year, and certainly a lot lower than it was at some points in the year. Okay, so it's kind of in the middle of that range. And then when we look at indices, where did my things go? Okay, we are going to add another gadget. So we are going to add we're going to add a watch list, and we're going to bring in our sector indices. What's going on here? Get rid of that. Okay. Well, I don't need 2 watch lists, so we're going to get rid of this one also. The good thing it's Friday because, it seems to me there have been a lot of weird things happening with my systems. But if we take a look at the last 3 months, communications, technology, consumer discretionary, and energy leading the pack. And then in the last 4 trading weeks, communications, energy, and technology. And so we see 3 of those 4 continuing to be strong. In communications, we're seeing a similar trend that we've seen in the overall market, but energy is all of a sudden kind of coming into its own. Where technology and communications have been kind of leading the pack all along, right? Right. And so that may skew how we look at things. So, and by that, hence, whoops, we'll look at, this energy company to get us started. And what we saw with this company, we had a bit of a cup and handle type pattern. And then when it broke out, holy smokes, Batman, like it took off. And so we had this extraordinary move to the upside, and then it pulled back. And if you're not familiar with this company, you may want to come to the Analyze tab, and you can see that, this is a coal mining company, and they have mines in Australia, Japan, China, Taiwan, like many, many places around the world, founded in the 1800s and headquartered in St. Louis. And if you wanted to see what these companies, the details on why these companies have rated this energy company strongly, you can click on them and have a look. But for our purposes and the type of strategy we're looking at today, I'm thinking, could we buy 100 shares? And if it pulls back, we could end up in a pickle. And we have to plan for the pickles. We're going to look at some pickles a little later today. But, you know, if this has pulled back, if this is about to move to the upside again, could we take advantage of that by maybe it's at 24.71, selling a buy right at 26? And we talked about this in the trading price patterns on Wednesday. So if you missed that class, I encourage you to go check it out, because we added 3 energy stocks to our portfolio and we did buy rights on all of them. And I'll show you what those were after we place this trade. But, you know, so if we come and we look at BTU and we come out to October, one, we want to look at implied volatility, and that is high for this stock. And so what that it means is this is a $24 stock, and it's saying in the next 21 days, it could move in excess. The anticipated 1 standard deviation move is $3 either up or down. And they're willing to pay, you know, we've got lots of volume here, you know, over 1,000 contracts, 91 to 96 cents for this 26 call. And you may say 26 cents isn't a lot, but on a $26 stock, like that's got to be what, over 3%? And so if we look at this and we say, well, if we were to buy 100 shares of stock and sell the covered call, how much could we make? Well, the most we could make is $125. But if we say, okay, that's if we're called out. If we make that 125, and we divide it by the 23.75 that we're paying to enter the trade, that's a potential return of 5.26% in 3 weeks. And so if you look at that and you say, well, that's not too shabby, but you know, we might be willing to place this trade, but where might we put a stop? And so if you say, well, it's come down and seemed to find a support level here, you know, around this, like our low this day, 24.35, 24.22. How about if we looked at 24 as our support level and put a stop 3% below that? So that would be at 23.28. And so then how much are we risking? Well, we're only risking about 50 cents if our stop is at 23.28. And how would we put that in? We're going to change our single order to a first trigger sequence. We're going to right click, create an opposite order, make it a market order that's good till canceled. And then we're going to bring up our disappearing, reappearing conditional order and say, hey, if this goes below 23.28, we'd like to exit. And here it says less than or equal to 23.28. If you don't catch it there, when you come to your order confirmation, you may want to read this out loud. We want to buy 100 shares of stock and sell the 26 covered call, currently trading at 24.66. Got it. If it goes below 23.28, so that's down about $100 and some, we want to exit. Okay. So we're going to put that in our buy right covered call. And again, when we have, you know, an exit here, you know, it doesn't guarantee if the stock were to gap down, we could end up out at a lower price, right? Right. But energy seems to be strong. This company seems to be, you know, moving strongly. And so that's why we're looking at that one. Now, the other one is not in the energy sector. It's Intel. And what's been kind of unique about Intel is that the government is taking a financial interest in it, and that's not often done. It's somewhat unique. But the market seems to be responding pretty well to that. And we had a stock that was, you know, kind of going a whole lot of nowhere, kind of trading in this range for quite some time. And then this announcement was made and this stock took off, pulled back, and you know what? It's moving to the upside again. And when I looked at this and decided to use this as an example today, we had very much a doji type pattern or a hanging man kind of pattern. Okay. And I looked at this and thought, well, what if this comes down? And so, well, what if it comes down? And it might come down to like this 32 level. It could come back all the way to 28.78, or it could just keep going up. But and this is where if you buy the stock, if you sell a covered call, you could end up called out. But if it pulls back, depending on where you put your stop, and our last stop, on BTU was kind of tight. But if we put our stop and said like, hey, we recognize that this could come all the way back to here. But what's the volatility like on this? Today, it's up another 5% and it's hit, almost $36. So here again, we have a lot of volatility with this stock. So what if we just came out 3 weeks? We've got tons of contracts and said, what if we just sold the 37? We're kind of selling it in the middle of the road. But we're also realizing that this has had an extraordinary move to the upside, and it could well pull back. And so if we're buying the stock and it continues to go up, we get called out, we made a little bit of money. If it pulls back, we can buy back the call and then do a wash, rinse, repeat and sell another one. And so this is not a typical entry. This is a typical being, we're not buying it here, when it's bouncing off a support, we're buying it when we're seeing that it might be hitting an anticipated resistance level after such a dramatic move and maybe pull back. And by selling the call, we're looking to maybe make some money by buying that call back. Okay, so the thought process behind it is a little bit different. Somebody's saying, well, what about doing a married put? So a married put, so we could do that. This is saying, hey, if this comes back, we could give ourselves the choice of selling the stock. So we could look at that as well. And it just depends on where you want that put to be, because the put's expensive because volatility is so high, right? So if we change that to 20, okay, 30. Well, if we did a married put, and this is saying like if this came all the way back to 28 and kept on trucking, kept on falling, we would have the right to sell the stock at at $28 no matter what. And that's if you're willing to be stopped out at that price. If you're saying, well, no, I'm not willing to be stopped out there. How about at 30 and I'd pay 36 cents for that? So let's look at the buy right component first. So if we sell this 37, so we're buying covered stock, what's the most we could make? Well, it's 33.74 is our price to get in. So 34, 35, 36. So we could make 325. Like that's getting close to 10%. 325 divided by 33.75. That's 9.6%. Okay, now if we put a stop in, if we're getting in at 33, let's say we put the stop in at 30, then we're risking 375 to make about 325. And so how would we add that? Well, if you're buying something, they always want you to pay more. So, oops. What was the mistake I made? The mistake I made was that I didn't make it first trigger sequence. So we're going to buy our covered stock, change this to first trigger sequence, and then we're going to buy a put, which is they call this a married put. So it gives us the right, because we're marrying the purchase of the stock with the protection of the put. And this goes until the 17th of October. Okay. Yeah. Okay, so confirm and send. So we don't have to put in a stop on this because we're doing a buy right covered call with a married put. So whoever posed that question, yeah, thank you for that, because I think that was a good idea. So we've now done 2 buy right covered calls, and the second one kind of with a twist. Okay, so let's come now and look at CrowdStrike. Now, CrowdStrike, this is kind of a more typical bullish entry, right? In that it's gone up. We've got this nice bull flag type pattern. Today, what's that pattern on the chart? This would be a bullish engulfing pattern. And if you're new to candlesticks, if you may want to join us for the Getting Started with Technical Analysis series, and I do a whole thing on candlesticks. But we have this bullish engulfing pattern, which if this candle stays like this through the end of the day, is a candle pattern that does not require technically confirmation. And so, but what's our hang up here? Is that if we did a buy right, we're looking at over a $40,000 position, which is kind of tough to pull off when you have a $30,000 account. So a buy right, this stock is out of our snack bracket for that trading strategy. So what could we do? Well, we could buy a few shares of stock and we could do a swing trade. And, while that's pretty interesting, and we can take up to a $5,000 position, but the catch is that we don't even have $5,000 left in the account. We have $2,800. So it's like, gee, that might have been kind of delicious, but, delicious and nutritious, but, we can't do that. We could buy we could buy 4 or 5 shares. So we could do that, to just see how that works. Or what else could we do? Well, we could do a long call vertical, I can speak honest, if we're expecting it to move up. And so if we come out to our trade tab and we say, okay, if we're looking out 21 days, and we typically look at the 20 to 50 day range, what's the advantage of 21 days is that if it goes in the direction we're expecting, it could meet our target faster. But if it doesn't, it gives us less time to recover. Now, does it trade more than 1 million shares a day? Typically, yes. Do we have lots of contracts on the books? Yes. Is the bid-ask spread tight? And by tight, we want it to be less than 10%. So this is 50 cents, but it's a $15 option. So is that less than $1.50? Yes. So if we look at straddling this, and it's currently trading just above 480. So if we look at buying a vertical, we're going to pay 243. Now in this class, our goal is on this strategy is to get out when we have a 50% return. And so how much could we make on this? Well, we could lose 218. We could make up to 280. And I used to want to make every bit of that 280. And how often did I do it? Almost never. And so I hated these strategies. It's like death to the long verticals. They never work out for me. I'm cursed. And then I realized I was kind of being a little greedy. And so what I started to do was say, well, what if I just went for 50%? So if I take that 235 and I multiply it by 1.5, that's 352. So I'm going to say, okay, when this gets to 352, okay, 360, and we can risk $500. So we're going to do 2 of these. We want to get out. And you might say, yeah, but you're leaving like 100 and 40 bucks on the table? Yes, we are. And why are we doing that? Because we're happy with 50%. We don't want to be a greedy guts. You know, we're saying if we can make a 50% return on a trade that we're in for 3 weeks or less, that's pretty impressive. And what if we look at this on Monday and we're up by 40%? Might we just say, you know what, 40% good enough, we're going to take it? Absolutely. It doesn't mean you have to stay in that long, but that's the goal. And if you get close and it looks like it's going to pull back, well, then we can exit the trade. Okay. How about the Googs? So let's look at, I always think of this one as Google. It's Alphabet is the name of the company, as you all know. And in an average day, this stock moves $5.34. So again, when we look at this, might this be a buy right candidate? Sure. But, again, one contract, 25,000, our max position size is 5,000. So, no cigar on that one. And then, could we do a swing trade? Well, we could, but again, we're a little cash light. And so could this be another example where we look at a long call vertical? And we've got earnings coming up, but not till the end of October. So if we came to our trade tab, and again, if we just came out this, we don't need that many contracts anymore. If we look at it's at 247. So if we did the 245 and the 250, we've got almost 20,000 contracts here, a 10-cent bid-ask spread. So if we did that, it has to move how much? Not very far. Now, if we did the 247.50, we'd pay $1.35. 250 would be our max gain. But if we go to 250 saying, hey, if we're bullish on this, we're at 258. So, we're risking 250 to potentially make almost 250. We could make 242. But again, we're saying, hey, if we could make $1.28, which is a 50% gain, we'd be happy campers. So single order, we're going to do 2 of these. How much could we lose? The entire amount. But the goal is if it goes against us, we get out. So we're going to make this 390. Good till canceled. Confirm and send. Long call vertical. Okay. So we're doing okay time-wise. So I had promised, because we did a lot of, trade comparisons where we'd place 2 totally different trading strategies on one stock at the same time. And Louis is asking, what if it goes bad? Well, if we're down 50%, we're going to manually go in, cancel that first target exit, and we're going to get out. Alfred is asking if there's an investment plan. And I have not paid him to ask this question, but the answer is yes for both of these strategies that we've looked at today. And so this is why you want to subscribe to the Trader Talks webcasts on YouTube from Schwab Coaching. There's a button in the bottom right corner of your screen. So if you haven't done that already, you're going to want to hit that. It's free to join. So I always like the sounds of free. And, when you first get here, you'll see what's currently playing. If you come to playlists, and they let me create just a separate little group for, I call it the trade management mini sessions. And remember when I talked about doing candlestick patterns? Well, so here's a short video on the bullish Harami. Here's one, on the hanging man and the hammer and the inverted hammer. So if you want to, these are little snippet videos. But here's an example trading plan for the buy right covered calls. And you can watch this and from that, then create your own trading plan. And so that's an example trading plan, Alfred, right there. And then, you know, here's one for long call verticals. Okay. Yeah. So there's that. Okay. So let's come and have a quick look at Baker. So Baker, back here on August 27th, we placed 2 trades. So one was a long call, you know, that we had put a target on. And the second was a buy right covered call that didn't expire till October and at the $47 mark. And it has obviously gone way past that. Okay. So we hit our target and exited the long call. And then we still weren't out because it's still not October 17th. So on Wednesday of this week, we decided to take our money on Baker. And so you can see here on August 27th, we placed these 2 trades, a long call where we paid $1.83 for it and could have lost it all. And then on September 4th, it hit our target. So we were in the buy right 20 days longer, but we chose to exit. And this wasn't, we got called out because you'll never get called out in paper money. We might have been called out in a live account. But how did the math work out on these? Well, seeing as we have a couple of minutes, let's just look at it. So our long call, we got in at $1.83. We got out at $2.65. So what did we make? We made $2.65 minus $1.83. And that turned out to be, I did the math ahead of time, $82 or 82 cents, $82. And we did 2 contracts. So that came out to $164. And we call that a base hit in this class, and we're pretty happy campers. Okay. Now, what was our return on our risk? Because we could have lost that whole amount, right? Or return on our investment. You know, well, we take the 82, divide it by what we could have lost, which was the 183. Sorry, my writing with these mouses is not great. That's a 44% potential return. Well, it was a 44%. It was our actual return. Now, what about our buy right? Well, we did it the same day. We got in for $43.93. And then on Wednesday in our trading price patterns, we decided to take the money. And why is that? Well, the most we could make was $47 and we were at $46.39. And we said, well, do we really want to stay in it for another like 3+ weeks? So with our buy right covered call, we said, you know what? We're going to take the money and run. And so how much money did we take? Well, we got out for $46.39. And, you know, there was a transaction fee to both open and close the long call and to sell and buy back the covered call, but they were the same. And so I'm going to leave that out of this discussion. It was $1.30 per trade. Well, this one was $1.30 per contract, and there were 2. So our transaction fees on this were $2.60, and on this they weren't the same actually because we just did 1 contract. So they were $1.30. So $43.93, assuming you did them through Schwab. And so our gain on this was $246. You know, or, you know, it turned out to $246. And so we made more on the buy right, but we were in it 3 weeks longer. And then how much were we risking? Well, we did have an exit in place, but how much had we invested? We had tied up $4,393. And so our return on investment, when you look at it, was we made 246 on an investment of 43.93, which looks like about 5% when you eyeball it, right? And it was actually 5.5%. And so you might say, well, obviously doing the long call is better, but not necessarily, because the long call is directional. And if it hadn't moved in that direction, it would have expired worthless. If this had kind of gone a whole lot of nowhere, this would have expired worthless. We would have got to keep the $92, and this stock might have been worth still close to the same amount. And so, it's not really an apples to apples comparison. And both of these happen to work out, in our favor. And that doesn't always happen. Okay. But so that's our comparison on that. Now, and part of the reason that we wanted to do this also, and if you missed the class on Wednesday, we added a position on Apache, which was in the oil category. We added a position on Devon, which is another stock in the oil, in the energy field. And then we did a third one on Halliburton. Okay. And so, when I looked at these earlier, they were all in the green. BTU is down a little bit, but they're all just percolating. And most of these, are pretty new trades. Okay. Okay. And so whenever I see a lack of a chiclet over here, that concerns me. I'm thinking, ooh, did this expire? But we just put this on. So if you look at it, it's like, oh, right, there's no chiclet because we have a protective put. And that one we just put on. Okay, so then there's one trade that we have to manage. And this is in our short put vertical bucket. Short put verticals. And so when you're looking at short put verticals, and geez, we're down $1,300. It's been a tough week, but you can see that two of these are coming back around the bend. But whenever you see something in the money, and we were going to deal with this one on Wednesday. Oh, this is interesting, because when I looked at this, just before the class started, it was at 537. So in this situation, we have an exit in place at an 80% gain, but it's through both strikes. Now, had I been able to buy this back for 460, which is what it was at, an hour ago, I would have closed it out. But this is an example where it's through both strikes, and through both strikes by a hefty margin. And this is one where we had a short time frame expiring September 26th, and then one expiring through 3 weeks from now. And so we are going to let this one expire and take our max loss. And, because the probability, if I put the 580, the probability of it by the end of the day coming up to 580 and being above 580 is quite low. And so what happens if this expires through both strikes is it will exercise both the short, which says you're buying shares, and the long, which says you're selling. And so we're going to take our max loss on this one. But it's come down and seems to have reached a support level, and we have 3 weeks for it to come back up. And this stock on an average day moves about $9.45. At least that's what it's moved on average over the last 14 days. And so it is possible, it's at 567 right now. Here was recently 2 days where it's just, it moved up $22 in 2 days. Now that might not happen again for months. But we'll monitor this. And so when we look at this one expiring October 17th, what I find kind of fascinating is that even though it's through both strikes, if we exit, we're down, $1.25 on this one. We're down by $125, but our max loss on this is actually 325. So we could lose a lot more. And so, we'll look at this one again Monday, but this is an example where now it's saying 487. So if you wanted to say, I just want to get out of this and I don't want to, take the risk of it moving up, what we would do is come here and cancel this order. And so we'll now see that this order will be gone. Okay. Or you could cancel and replace it. So we're going to highlight this, create a closing order, and say, okay, if we have to pay $4.95, there we go. And if it doesn't fill, then both sides will be exercised. Okay. Okay. So we've got to wrap up now. So here are my asks as we close out this class today. One, if you would do me a favor and hit the like button. First of all, it sounds like applause to Connie and I, and it lets us know that you like what we're doing in this class. More importantly, the more likes we get, the more it moves this up in the YouTube algorithm. So the more people that will find this content. And so, it's a chance for you to do a favor for a random stranger whom you may never meet. Second, if you haven't subscribed to the channel, you'll want to do that. And then you want to make sure you're following Connie and I in the land of X, Connie Hill CS, and Barb Armstrong CS. And there isn't a survey today, but when there is a survey, one of the things that I'm often asked to do is just review what we did. So we closed out a trade gone wrong on a short put vertical on MasterCard. We opened a position on Intel where we did a buy right covered call with a married put. We did a buy right covered call on BTU, which is in the energy category. And then we did long call verticals on CrowdStrike and Google. So that's a wrap for today, my friends. Get out there and hug someone you love. Have a really awesome day. Thanks to Connie for her help in the chat and the guys behind the scenes for helping bring this webcast to life. Take care. We'll see you on Monday. Lots of great content still to come today, so stay tuned. Bye for now.